it's just weird, man. It's just a weird time right now. The lenders are really weird. So I like to get from your perspective.
Oh gosh, we don't have enough time on this podcast to go through that because there's a lot going on. I can say this: I work in the private lending world, so we're somewhat removed from all of that chaos that you're seeing. We definitely are benefiting from it. So when banks start to fail, like you've seen, by the way, that those aren't going to be the last. I know the government's telling us it is, but it's not. It's gonna get worse. Anyway, so when you see that, when bank peers start failing, it freaks banks out, right? So now they tighten the suspenders, they tighten up, they put their pencils down. They're not doing loans. So us as a private lender, we get to benefit from that. Like we have good quality bankable deals coming on across our desk pretty regularly right now, deals that we would never have a shot at before, right? So for us, we're really enjoying this. Now we're getting squeezed a little bit on the margins because interest rates are higher. They're low now compared to historic, like in the 80s, right? And you mentioned 2010. I don't think there's a lot of, other than a couple of bank failures, I don't think there's a lot of comparison between 2010 and what's going on right now. I think it's very much more similar to after the savings and loan crisis when we had hyperinflation and hyper interest rates. The difference between then and now is the interest rates doubled, 100% increase in rates in less than 1 year. Even that didn't happen when we saw interest rates at 18 and 19%. Those raised 3%, but they started at 15%. So this is historical damage that the government is doing to the economy right now, trying to get it under control from the damage it created for itself during COVID.